Hi again, it's David Goldberg from United Trust Bank. Today I'm here to talk about mortgage rates, real estate, and recessions. There are three big factors at play in 2022 that are affecting mortgage rates. The first is inflation. And as prices rise due to inflation, a mortgage holder that's holding a bond for a 30-year period of time, the term of the loan, makes less and less money as prices rise. Therefore, lenders have to, in turn, increase rates to continue making profits. The Federal Reserve also has impact on mortgage rates. The first is in the Fed funds rate. When they increase the Fed funds rate, counterintuitively, it actually helps mortgage rates by slowing down the economy. Counter to that, though, is balance sheet runoff. And over the past couple of years during the COVID era, the Fed really purchased a lot of mortgage bonds, mortgage-backed securities, and that helped keep rates low to those all-time levels we saw over the last couple of years. As that purchasing has stopped, and now they're allowing those bonds to run off of their balance sheet, that will actually cause rates to rise. So the Fed's actually doing two different things that affect rates inversely. And finally, recessions. Right now, the forecast is for the end of the year, beginning of next year, that we'll see a recession. And what does that mean for mortgage rates? So let's look at the Fed history. During the Burns-Volcker era, all the way back in the 70s and 80s, inflation went up from 7% to 14%, and the Fed funds rate increased from 11 to 20%. This actually decreased inflation, leading to lower mortgage rates, dropping from 18% down to 12%. This period of time was a recession, with the Dow being down 30%. In the Greenspan era, the Fed funds rate was increased from 4.75 to 6.5%. This decreased inflation from 3.5% to 1%, leading to mortgage rate declines from 8.5% to 5.5%. This period of time was also another recession, with the Dow being down 50%. Under Jerome Powell, the Fed has started increasing the Fed funds rate from 0% to 0.25% this past month, and this is expected to continue increasing to around 3% by the end of the year. This would lead to lower mortgage rates and inflation to drop, and most experts believe a recession is unavoidable at this point. This next chart shows a history of hikes on Fed rates, balance sheet runoff, and inflation. You can see that in this rising of rates, leading to lower mortgage rates in almost every case. So there is a bright future for mortgage rates once we get past the Fed's runoff. Next, we'll look at inversions to the yield curve. Typically, longer-term bonds have a greater return than shorter-term bonds. This makes common sense, as the longer you tie up your money, the greater return you would expect. When you see a shorter-term bond, like a 2-year, giving a higher return than a longer-term bond, a 10-year, you know we are headed for a recession. When you subtract the 2-year yield from the 10-year yield, and the number inverts to a negative number, which happened this month, every time in history we head to a recession, as seen in the red sections on the chart. Unemployment also affects mortgage rates. When the unemployment rate reaches its lowest level and then starts to rise, a recession is very likely. This has happened every single time. When the Fed's current hike rates, take effect and unemployment starts rising, we're likely to see another recession start later this year or early next year. So what does that mean for rates? Every single time we've seen mortgage rates drop. And what about housing? With the exception of the 2008 recession, which was caused by the housing bubble due to high risk financing like stated income loans and 100% financing, as well as the overall lack of demand for homes, this was the only time prices actually dropped during a recession. So, why is this different from 2008? Well, housing inventory is the biggest factor. We now have a low of only 870,000 homes for sale in the US, down from a peak of 3.7 million in 2007. There's been an all-time average of 2.5 million homes for sale, so we're still well below that level. This lack of supply will continue to keep prices rising, even if at slower rates than what we've seen of late. There are also more households today than at any other time, up from a low up from a low of 116 million in 2007 to 130 million today. Yet another reason to believe that the demand will keep housing prices climbing. While we need to get through the next several months, the future does look bright for mortgage rates and for housing. If you have any questions about anything I discussed here today, reach out anytime. I'm here to help and look forward to working with you on your mortgage. Have a great day.